Good evening, everyone, and welcome along to tonight's presentation hosted by Real Estate Investor and GCT Property. So for those of you that are familiar with the Real Estate Investor platform, fantastic avenue to have tools to find, search, value property. As many investors will be aware, there's a real shortage of property for rental at the moment, a real crisis, and that's really leading to some great opportunities for property investors. So just before we get underway, you'll notice a question bar on the right-hand side of your screen. If my audio is coming through loud and clear, if I could just please have a yes in the question bar, that would be really appreciated before we roll into the presentation. So I just want to check the technical side is working good. Thanks, Roger. Looks like we're all good to go. Appreciate that. Thank you. Okay, so tonight we're really going to focus on property investment. We're going to look at the ways of overcoming the interest rate rises. We are going to look at what's happening in the property market around Australia with a bit of a wrap up. And again, there's really been some changes in the last few weeks in terms of market confidence. And as I think things start to stabilize, and it's going to lead to some great opportunities for those property investors that are ready to take advantage of the market. I'm sure we've all seen that pause in the market over the last few months, but when you look at recent auction clearance rates, buyer confidence, and some of these prices that are achieved, very high. So fantastic time to look at property investment as a strategy. So obviously, as current property investors, we're affected by the recent rate rises. They have definitely affected our cash flows and our returns, our yields on our properties. And tonight we're going to show you a great concept and a way of really overcoming that and changing that, improving that cash flow and that yield of that property. So just a general disclaimer there that the information that we provide tonight is generic in nature. We don't understand excuse me, your individual investing position. So of course, we always recommend that you seek professional advice before investing in real estate. So Real Estate Investor, it's a technology company that has tools for property investors. I work with the company. I've been using these property investment tools for probably 11 years, over 11 years in fact now, and haven't found anything better on the market, from finding properties to doing all the the market research. As investors, we really need to understand the market conditions. What's the market doing in that particular area that we're looking to invest? So we have an access there to CoreLogic RP data, which is a valuation tool. You can analyze the property, look at the market history, how long it's been on the market, whether it's been reduced in price, whether it's failed at auction, how long the owners have owned the property, what they paid for the property originally, and right down into the suburb statistics. What's that breakdown of that, the demographic of that particular area. So I wouldn't consider buying any property without looking at the CoreLogic data information, because that's really key to what properties are actually selling for. There's a developer's tool for those looking to buy land and subdivide called ArchiStar. So it has access to every council code in Australia. So once we've found a site that may potentially be suitable, with the ArchiStar tool, we can actually start running all the overlays, make sure that it's not flood affected, bushfire, easements on the site. We can see the codes for the property, setbacks, what the council will allow us to build, how high, site coverage, what the density of the block will be. Very important data if you're looking to subdivide. The property analyzer there, that's a cash flow forecasting tool. So if you're looking at changing your finance structure, trying to improve the cash flow of the property that you've currently got or about to purchase, and you want to run a few finance scenarios through a calculator, the property analyzer tool is very, very explicit, and it covers the details. So it shows you the gross yield, and then you put all the property expenses in, and it will actually show you the net yield. How much is that property costing us or paying us this week? And it's very easy to analyze, very handy tool. And if you've got any current properties, as I mentioned, you can put all the data, the loan structure, the interest rate, and then do some comparisons. Is it worth refinancing or changing the finance of that current property to P&I to interest only? How's that going to affect the cash flow? All that bit of data is in the analyzer tool. And then the tool on the right there, Portfolio Tracker, that's for those that currently own investment properties, and you can put each of your properties in the tracker tool, and that will allow you to monitor those properties and see how they're tracking very, very quickly. So you have the address of the property. If it's rented out, you have the property manager's details, your lease agreements, tenants details, all your tradesperson details, your finance structure. It's all in one place, so it makes it very easy to check in on that property every 6 to 12 months. And see really how it's going. So that's the key to long-term property wealth growth, is being able to build that successful portfolio and take advantage of the market when your properties are growing. You've got that equity, surplus equity in the property. So the Real Estate Investor platform is a full suite of tools, and if anyone's like to find out about that tools and how it works, please put in the question bar there a message about that and your contact details, and we'll explain that. We'll send you an email tomorrow about the full suite of tools through the Real Estate Investor platform. Very detailed, and it covers really all the data about property investment. So my name is Geoff Tomkins. I've been a property investor originally in New Zealand and now Australia, so probably well over 25 years now. I was originally buying property, renovating. I've done small lot subdivision, built new, bought multi cash flow properties. So really still love property to this day, still get excited. So I worked for the Real Estate Investor platform, as I mentioned, about 11, 12 years ago, and then I went away and got my real estate license, and been operating as a buyer's agent probably for about the last 10 years now. So I'm in the market looking to buy properties for my clients or for myself, and really got a hands-on approach when it comes to property. So you can do a lot of research online, but I think it's really important to have someone to actually check out the areas and the locations and the property type as well. So I use those Real Estate Investor tools myself, and really get down on that groundwork and find those properties for the clients. So the information that we're going to talk about tonight is coming from real life data from ourselves as property investors. We're going to have a look at the agenda that we're going to cover off tonight. So initially, we're going to look at what's happening in the Australian property market, some exciting things coming, I think. Again, a few changes. We're just starting to see the levels of confidence. There's a few key indicators that we're going to cover off that are going to show us that. We're going to focus on probably the fastest growing property market in Australia, which is the Southeast Queensland corner. And then we're going to show you how to calculate the cash flow of a property, the importance of it, and we're actually going to show you with a very specific property type of how to increase the rental yield of properties that are going to produce much more income than a standard house. So potentially could change that negatively geared property into neutral or positive cash flow. And we're going to look at one of those properties in detail in terms of the property type, the location, and I've actually done a cash flow analysis based on some generic figures, and we can show you how that will work in terms of cash flow. So, a lot of content to take in tonight. We will be recording tonight's session, so you're welcome to take notes, screenshot, but you will receive a full copy of the recording tomorrow from the Real Estate Investor team. So you don't, if you just want to focus on the content that we're talking about, please do that. And as I mentioned, you'll get a copy of the replay tomorrow. Welcome along to those that have just logged on in the last couple of minutes to the presentation tonight. There is a question bar on the right-hand side of your screen, so I really encourage everyone to type in questions as we're running through the information and the tools tonight. And this webinar will run for around about an hour, and then we'll open the floor up and we'll go back into Q&A. So type the questions as you're thinking about them as we're running through, and then I'll get back to and answer those in the Q&A session. So some of the key topics were, again, we're going to look at the property market, what's happening, the changes that are coming through. We're going to show you how to locate and value those higher cash flow type properties. We're going to explain the strategy around that in a lot more detail. Fairly new concept. It's really getting a lot of momentum from those looking for high cash flow type properties. And we're actually going to do a walkthrough of a actual property and explain that in a bit more detail. So of course, interest rates have been a big topic of contention over the last 8 months. I don't think we've ever seen so many rate rises in such a short period of time. Pros and cons for everything in life. Yes, interest rates have gone up. Yes, our borrowing costs have increased. Yes, our yields have dropped, but that's because the Australian economy and the property market has been, performing at a very high level, and the RBA are obviously trying to control that rate of inflation and get it back to the target rate. So there's a lot of good things coming out of the Australian economy. Interest rates, yes, sure, they have doubled over the last 8 months, but when you look back in history, interest rates, as you can see there on the chart, were much, much higher. My first property purchase in New Zealand was at 20% interest rate, and I paid around that 10% in Australia. Properties were still growing in value. So yes, interest rates are one component, but they're not the only thing or only component that controls the property market. So just bear that in mind, that we are still at rates well below the average over the last 30 years. And of course, the RBA board is looking to bring that inflation back under control. And I actually just heard a report today, the figures were out, that inflation was, I think it was dropped around about that 2% over the last quarter, which is quite significant. So obviously those factors of those higher interest rates and all our mortgages have increased has made it we all need to tighten our belts, reduce our spending, which is helping bring down that inflation. As you can see there's a graph on the screen. So the figure in the solid bar in the orange there is the mortgage interest rates, which again have obviously been historically low. But what we're seeing in the graph lines is the property market. So even when we've had periods of much higher interest rates, and we've had lots of challenges to the economy, so we've had mining booms, the GFC really restricted the market. We saw a lot of price points go down, but over the long term, the price point in all those capital cities around Australia has been very, very strong, and averaging around that 5 to 7% capital growth for the average house in the average suburb in those capital cities. So it's the long-term growth of the property market. But even those periods where we've had those higher interest rates or financial challenges, the property market has still performed very well when you look at the long-term average. So we need to sit back and not just think of the last 2 years when massive price growth and huge interest rate increases, but look at the longer term as the market starts to really settle down, and just think back to what interest rates were much higher 10 years ago, and properties were much cheaper than they are now 10 years ago. So there's some learnings in that history there. The Australian property market update, so what's happening around Australia. So the first time since, I think it was about April last year when the interest rate started to rise, Sydney's actually seen some capital growth, which is fantastic. So more importantly, when you look at the capital cities around Australia, those markets that were falling in price over those interest rate rises that fall has really pegged back now, and it's very minimal over the last month. So you can see the capital cities around Australia there, very, very low, under 1% capital growth decline over the last month, and compared back to the last 12 months and last quarter, that's a very significant change. So again, the market is really, really turning, and we need to be aware and watching very closely what's happening, because the data gives us indication, but the data is generally after the fact. So if the data is reporting the property market prices have changed, that market's already changed. So we just really need to be on top of that, and not listen to those pessimists and talking about the market crash and mortgage cliffs and all that. You've got to look at the whole market and listen to those well-respected property educators and market indicators that have seen a lot of different markets. I've seen higher interest rates, I've seen natural disasters, I've seen GFCs, I've seen share market crashes, and they're looking again at the longer term growth. And just think our medium values there are still well above what they were coming out of COVID. So again, if you average over the last 2, 3, 4, 5 years, the capital growth in those capital cities has been very, very strong. And markets don't always go up in value. There's periods where probably 2/3 of the cycle really where property markets are pretty flat. So we see a strong boom at the last run of the cycle, and then we see generally a decline where the market's pretty flat. We see some negative growth, and then the market plateaus, and then the last third of that cycle we really see some strong growth. So I think that's what we've been seeing over the last 2 years. So I just got the latest auction clearance rates from CoreLogic that I researched today, And again, auction clearance rates, as you can see there, Sydney, Melbourne, very, very high. Even Brisbane, 56% for Brisbane's not traditionally an auction market. And those are very, very good statistics, and they're well up what they were in January of this year, only 2 months ago. So again, just look at this data, look at the statistics, and we're really seeing a change there. I'm listening to property auctioneers, clearance rates, market confidence, speaking to other agents in the market, mortgage brokers, etc. Mortgage brokers are very busy at the moment doing refinancing, new loans. So there's definitely some confidence coming back, into the property market, as you can see there with the, the auction clearance rates. So I grabbed some data from a chief economist, Dr. Andrew Wilson, and I started following him because his data, his information is very detailed, and he covers the whole market. He was a former chief economist at Domain Group for 2 years, and very well respected. He does a lot of data reports, so he doesn't sell property. He doesn't have a relationship with an agent, but his company simply reports on what's happening in terms of, the property market. What's I think is going to have a real effect this year is the Australian government has approved 200,000 permanent visa applications in this current calendar year, which is huge. It's massive. So we've already got an undersupply of properties, and now we're seeing, population growth. So that's what the government's approved, and that's just permanent residents. On top of that, we've got students now coming back into Australia. I know that. I speak to friends that are Airbnb properties and renting out to students, and the international student market is really starting to come back again with vengeance. So again, the population growth in Australia over the next 12 months, and these are figures that are going to be based over the next 5 years on average. So very strong population growth coming into Australia, and that certainly has an effect on the rental market as well as the selling market as well. And you can see the migration there, really the interstate migration really spiking upwards, over the last 12 months. And especially, as you can see there in Queensland, the orange line there, fastest growing region in Australia. And there's a number of reasons for that. It's lifestyle, it's I think more affordability, and we're really in a changing, market conditions. A lot of people can work remotely now. So coming out of COVID with technology improving, a lot of people can work. A lot of companies are quite happy for people to remotely, so they don't, if their head offices in Melbourne or Sydney, doesn't mean their staff or their team have to be in Sydney or Melbourne. So it gives us the team, the staff, the flexibility to work remotely. So again, there's a number of reasons for that, interstate migration. So there's definitely a changing in the market, and as property investors, we need to be following this. And these indicators will give us a bit of a guide where the growth markets are really going to happen, over the next few years. So we know we've got stronger population growth. We're already got a strain on the rental market, and we're actually building less new dwellings than we were, 5 years ago. So building approvals are currently down 29% on what they were in 2016, which is massive. So I'm sure we're all aware of, the building trade, like most industries, has been under a lot of pressure over the last sort of 12 to 18 months. Things are getting back to normal now, which is great, but we're simply not building enough new homes. So when you think about, if it's your next investment property or your first investment property, and you're concerned about finding a tenant, all you need to do is speak to a local property manager or speak to someone trying to find a rental property. We're in the Southeast Queensland corridor, as I mentioned, and it's very, very tough to get a rental property, and there's multiple applications on each property as well. Vacancy rates, just really proof in the pudding what I've been talking about there. So they consider, for anyone new to property investment, they consider a vacancy rate of 3% a fairly tight market. So what that means is for every 100 properties listed for rent, there's about 3 currently vacant. So they consider around that 3%, but all the capital cities are for houses are under that 1% or under, so very, very low. So those are the real numbers, and again, it just gives us that confidence if we're looking to buy an investment property and put tenants in place. Supply versus demand. I'm sure most property investors will be aware of these areas where there is a growing population, and that's why when you buy that property, don't just base it on buying the cheapest property in the cheapest location. You really need to understand the long-term fundamentals. I think the most important thing is to invest in an area that is growing in population, because that growing population will drive jobs, it'll drive infrastructure, and it'll drive the economy. So we know there's limited supply. We've seen the vacancy rates, and a segment of the market that is particularly struggling at the moment is that single person accommodation. Just experienced it myself recently with my investment property, where it was a dual occupancy on the Gold Coast, and had multiple applications for the rental property. And when the property manager considers the applicants, they'll look at their income threshold, much like a mortgage. And I spoke to a property manager just recently, one I've used for many, many years, and they use a 35% of your income maximum towards the rental income. So what it means is people on that average income, single people, are really missing out. They're really struggling because this is a couple or a high income earner applying for that unit or that house. Unfortunately, they're probably going to miss out. So one of the ways to check that is to go on a platform, flatmates.com. So this is a platform for people renting a room or looking for a flatmate to share. So we've all heard about the shared accommodation, and this is really the next step up from that. So just today we did a search on flatmates.com, and on the Gold Coast for rooms under $350 per week. So that's one room, remember, to share in a house at $350. And there was 809 rooms being advertised for rent, and there was 1,827 people looking, advertising, saying they want a room to rent up to $350 per room. So what does that mean? It means there's double the amount of people looking as there's actually rooms available. So a huge shortage, as you can see there. And if you look in a lot of areas, the numbers will be very, very similar. So that just shows you the demand for the single room accommodation. We are in a changing demographic now. The number of single people is increasing. Some people don't get into a relationship, don't have a family. Some people have come out of a relationship. We've got people like fly-in fly-out miner workers, people that work remotely that just need basically a bed and a room, and don't want to rent a house if they're not there. So there's a lot of people in that space, students coming back into Australia, immigration. There will be a lot of single people immigrating to Australia permanently, and that's only going to put pressure on rental accommodation. So tonight we're going to really focus on one way of overcoming the higher interest rates that we're all facing. And this is a fairly new concept designed to cater for that shortage of single level accommodation. So I'm sure we've all seen, the current affair programs where it's very sad. A lot of people are really living in below standard accommodation simply because they can't afford or can't even get a room or a house or a unit to rent. So this concept is really going to give investors a benefit as well as those single income tenants. So on the left-hand side, that's the standard house. So these figures are sort of based it on the Queensland market. On a property worth about 770K, the average house, we're going to get about $650 a week, and that's about 4.5% gross rental yield. So we compare that, and if we're borrowing money at 5.5 to 6%, that's going to be a negatively geared property. As we look at the co-living property for that same purchase price, our rent's going to increase from $650 a week to $900. So we're getting 35% more weekly rental income, which shoots our yield up dramatically. So I'm sure you can see the difference there and the real benefit of this co-living property and how it's going to perform in terms of cash flow. So we're going to look at why the reasons we would look at co-living as an investment property. Well, number one, we're going to get a stronger cash flow, so that's going to help our yield on our property. That's going to help manage our budget, of course. That's also going to help when we come to build our property portfolio and refinance. Actually, just speaking to a broker today, and there's actually some lenders that will take that higher income into account on the serviceability calculator as well. So again, the banks are taking this into account and realizing a lot of people are buying properties with multiple incomes, granny flats, co-living, dual occupancies. And I think initially the banks had some concerns about the longevity of the rental income. I've had dual occupancies. My first one probably built it 7-8 years ago. It was always tenanted, so there's a long-term demand. So the banks are actually, some of the lenders are actually factoring that in, which was something that I learned today. Satisfying the demand for affordable accommodation, as I mentioned, a lot of people are really struggling. They simply, can't afford a unit or a house. Again, if we're looking at the Southeast Queensland market, very, very strong, lots of competition, multiple applications on most properties for rent. And, the property manager's role is to really take those applications and give the owner or the investor the best advice. And obviously a higher income on the application gives that, that more security. Overcomes the higher interest rates that we talked about, and again, interest rates are an interesting thing. Now we're seeing the major lenders talking about interest rates stabilizing, maybe potentially over the next 1 or 2 rate rises maximum, and then stabilizing over the rest of the year. And a lot of the banks are actually forecasting, and economists forecasting rate rises next year actually. So again, that confidence coming back from a number of things, and we're finally seeing those interest rates plateau, which I think is a good thing for confidence and also for those that have owning property or investment property. The other big benefit with co-living over some of those other higher income type properties is the exit strategy. So at some point when you come to sell down your portfolio, you'll need to sell those investment properties, and some of those higher student type accommodation properties are very limited. You can really only sell them to onto another property investor. The big benefit with co-living long term is it's generally not very different from a standard house. So you're suddenly opening up your end user market, potential buyers. So you will cater to home buyers because a fairly standard home with a few slight modifications, or it might be sold to an investor looking for that higher yield. And in terms of finance, it's much easier to get a finance for one of these co-living properties as opposed to a unit complex or a student accommodation type situation. So big benefit there. And also when you come to sell that property, you have a real point of difference over the other properties, other houses in the street. I will show you a floor plan very shortly, and then explain how the differential and the differences there in a bit more detail. So when we're looking at investing in areas, we should be looking at some, especially if we're buying for long-term capital growth and we're new to property investment, we want to make sure that our first investment property is a good experience, and we can see the long-term benefits as we hold that property for the longer term and see that growth, which will give us confidence to build that portfolio. I think where a lot of first-time investors go wrong is they don't really understand the markets, don't do the research, just run out and maybe buy a property because it seems cheap, or the yield's exceptionally high, but it might be an area that's not growing in terms of population, as I mentioned. So within a radius of a capital city, especially for your first purchase, look to invest where the government and private enterprise are spending money, because the government doesn't just spend money for the point of it. On infrastructure, there's lots of budgets in place, and there's lots of different councils applying for the state government budgets. So if they're starting to build schooling, upgrading roads, universities, things like that, that's a really good indication that they've done the forecasting, the population forecasting on the growth. And when you start to see those private companies come into the market, again, that's a great confidence sign. So you'll see, companies like McDonald's and Bunnings, companies like that, Woolworths, go into areas and they've actually bought the land ahead of the growth, and they're doing all their forecasting. So if you see a McDonald's go up, or a Bunnings or a Costco, they've done the research and they know that that area is going to grow in value. So again, they're doing making their decisions based on the numbers. We're looking for areas where vacancy rates under 3%, and that's most of Australia at the moment. But again, that will change, and some of those regional areas won't always be at that low vacancy rate. So again, just look at the the fundamentals and where people are going to continuously move. Where there's work, don't buy in areas where there's just one industry. It can be, you know, very, very risky buying into those areas. So, you know, I know when those mining towns are booming, the yields are very attractive. But I've seen the other side of it when those areas are relying on one industry and they've really sort of turned that industry, and there's no confidence, there's no people to rent your home, and the rents can, you know, drop significantly, as well as your home value as well. So again, if it's your first purchase and you're a very low risk type investor, definitely those areas of growth are more important. Looking for areas where the population growth is higher than the national average, and we talked about that Southeast Queensland market in numbers, and suburbs which are growing in infrastructure, growing in population, you know, where again private and government infrastructure is going on and developing. So talking about the Southeast Queensland property market and what's going to happen over the next few years. I'm sure most of you will be aware of the Olympic Games. That's you know, only 9 years away now. It is getting closer. We're currently in the Southeast Queensland corridor, and people are starting to talk about it. The Games Committee are looking at the venues and infrastructure. And if you go back to when Sydney, you know, hosted the Olympic Games in 2000, leading up to the Olympic Games and after the Olympic Games, that was a really driver for property prices to really start climbing in the Sydney market. So, you know, success leaves clues. And you know, that's a real confidence boost for, you know, Brisbane to host the Olympic Games. And there'll be a lot of infrastructure built. It'll create jobs. It'll create workers. So these people, you know, working on the villages and the stadiums, etc., will need to rent somewhere. So again, that's, you know, confidence for the low vacancy rates. We've got 5 cities within a 100-kilometre radius. I think that's pretty unique around Australia. So we've got the LGAs of Gold Coast, Logan, Ipswich, Brisbane, and Moreton Bay. So 5 large LGAs. There's 2 international airports. So there's the Brisbane International Airport and the Gold Coast, and they're all within, they would be within about an hour and a half of each other, you know, domestic and international airports, which is, you know, really important. Again, the world is really changing, and we're seeing international companies, you know, coming to Australia. And if you're working in the mining industry or work interstate, close to an airport is definitely a benefit. We're seeing the government and local government spend huge amounts of money on the highways and the rail networks, continuously expanding the road network around Brisbane, Gold Coast, Sunshine Coast. There's continuously work going on. So I know it's a bit of a bummer having to drive in that traffic and roadworks all the time. But again, if you're a property investor, think, hey, they're doing this because the population's growing and these people need to rent somewhere. So pros and cons, but again, money spent on infrastructure is a good thing, and confidence in the local market. The Southeast Queensland corridor, which is the greater Brisbane region, essentially has seen 34% price growth, you know, from 2021 to 2022, which is massive. One of the reasons for that was affordability. The Brisbane, much like Adelaide, we didn't see the price growth that Sydney and Melbourne saw over the last 10 years. Ours was a fairly consistent, steady market. And coming out of COVID, we saw massive growth. And again, interstate migration, people being able to work remotely, moving to the Sunshine State for affordability and lifestyle, really put a pressure on property prices. I bought my last home about 18 months ago in the crazy market, and it was just unbelievable. And what I did see was a lot of interstate buyers paying well above what the locals were prepared to pay, and that's really driven the property market, and that's going to continue to drive, you know, the Southeast Queensland property market. Still affordable, as I mentioned there, medium values in the suburbs in the Southeast Queensland corridor from around about that 500 to 900,000. The market is really moving. There's a lot of suburbs now with the median prices well over $1 million. So again, just, you know, people are moving here and prepared to pay that higher price. Rental yields 4 to 7%. And that's, again, that's higher than Sydney or Melbourne. So from an investor point of view, that's important. If cash flow is critical to you holding the property, you need to be buying in areas where the yield is going to be higher. So we're still achieving Good yields probably, the rule of thumb used to be 5%. I think that's on the average home not achievable now because property prices have increased by so much. Rents are starting to creep up. So somewhere around that rental yield and high demand for accommodation. We saw those, those vacancy rate figures. Southeast Queensland corridor. So for those that are not, sure of what that we mean by the Southeast Queensland corridor, so the map on the right-hand side of your screen. So that's essentially down the bottom of the page from Coolangatta, which is the Gold Coast, up to Brisbane, out west to Logan and the Ipswich corridor, and then up north to the Sunshine Coast. So again, it's a very, densely populated area. 10, 20 years ago, there was a lot of land supply. Now that's really been exhausted in a lot of areas. So land exhaustion really leads to price growth. Hence Sydney and Melbourne saw massive growth, and the greater Brisbane region is starting to see that, growth now. So quite a good rail and road network connecting the cities, but it's really under pressure from this strong, population growth. We mentioned out west to Ipswich, and if you're wondering if you've heard about Toowoomba, that's further out. So the Logan Ipswich corridor leads out to Gatton and Toowoomba, and that's a very strong agricultural area as well. So a lot of transport companies, a lot of employment around that corridor. Okay, so we talked about the property market, we've talked about the population growth, we've talked about the shortage of rental accommodation, and we've talked about the importance of having a high yielding type property. So what we're going to do now is we're going to explain the concept of the co-living. So as I mentioned at the start of the presentation, I'm sure everyone will have a lot of questions. I see a few have run through now. So if you have the questions about this concept or the market that we've talked about, please type them in the question bar, and that we'll get to that at the end of the the presentation, cover off those questions. So what we're doing, shown now on screen, is an example of a co-living property, and we're about to go into a floor plan, and I will explain the differences and how it can benefit you as a property investor, and also the benefits as a tenant as well. So you can see from the street front, looks like a standard traditional home, but it is a different configuration inside. So you can see the bedrooms here are larger than standard. And here's a floor plan. Just bear with me while I move my screen around. Here's a floor plan on the left-hand side. So what you can see there from the entranceway, so a standard double garage on the right-hand side, 3-bedroom home, 2 living areas. But what you see is when you come into the property, that each bedroom has got its own ensuite, which is great for this co-living concept. So it means each of your tenants has privacy. So on each of the doors, we have a digital lock. So we have a digital lock on the front door, digital lock on each of the bedroom doors, so the tenants have their own privacy. They can go into their room. They've got a larger than standard bedroom. So if they have a study desk or a couch, they can. Each bedroom's fully furnished. They have their own TV set up. So it's, very, in terms of security and safe, and a level of privacy that you wouldn't get with a shared property. So bedroom 1, an ensuite, etc. Still have a separate laundry there. Bedroom 3, the next one down, again has its own ensuite bathroom. And bedroom 2 has its own ensuite as well. 2 living areas, so it has a media room as well. So nice lounge, you could set up as a TV lounge room, games room type situation. And then your open plan lounge, kitchen, dining. And the other differences in this design, it's got a walk-in pantry, and each of the tenants will have their own lockable pantry. So you can see the builders really designed this. They've actually got their own property management arm of the business. So they've actually gone out to see single tenants. They've questioned them, filled in surveys, and asked them what they're really looking for. What's the market target? Tenants have said, single tenants have said, they want some level of privacy. They want some level of security. And this design, as you can see, is really designed to give you as much privacy as you'll get in a shared accommodation type property. So very functional, and very secure. And you know, the fact that those bedrooms are made larger and each has their own ensuite, each has a digital lock, so the other tenants can't get into the rooms. Just gives that tenants really peace of mind, and you know, hence these properties are achieving, you know, very, very good rental incomes. So I'm sure everyone's got a question of you know, how much are these properties and what sort of figures around them. So I'm going to cover off that. So you can see there the land price. So these are purpose built, brand new property. So you get the warranty with the property. So you get a guarantee with that. So it's very easy as an investment property. I think the last thing you want is an old high maintenance type property. It's not appealing to the tenants, and you spend a lot of money, you know, on the property. So low maintenance type investment properties, again, especially if it's your first investment property, and you're, you know, conservative in nature, you're doing something that's going to tick along and you're not continuously getting phone calls and spending money on, and you're looking for a high cash flow type property, these types of properties, you know, tick all the boxes. So land price, build price, and put a furniture pack in place. The reason we do that is when it's fully furnished, it's a lot more appealing for the tenants, and we get much higher per room income from the property. So you can see the purchase price there with the furniture pack, $769,000. This is a real live example of a property. The rental income on that property would be $300 per room. So we're getting $900 per room, sorry, $900 per week combined rental income. You've also got the security of, you know, never having the property vacant, because there's always tenants moving into the property. So whether you've got 1, 2, or 3 incomes, you've always got rental income coming into the property. The other big benefit there is each tenant's on its own lease. So that tenant in bedroom 1 is not affected by the tenant in bedroom 3 paying their rent. They're not relying on it. So they're responsible for their own rent, which makes it much more secure. So each of them have their own lease agreements in place with the property manager. The property manager in co-living is very important. A property manager that understands the tenants and can match, you know, suitable tenants up living together. So that's a very important factor to bear in mind. And the good thing about this particular Builder Gallery Homes is they've got their own property manager arm of the business, and they're leasing these properties out, so they're managing them. So they want to make sure they get tenants that are going to be, you know, suitable to live together, and also set the ground rules up front. And they are actually building them, they're leasing them out now, and the rent started out in most locations around that $280 a week. They're all start from $300 per room minimum now, and many are higher than that. So, you know, a much higher than standard income. And as you can see there, it's traditionally very similar to a standard home. It's 3-bedroom or 4-bedroom, en suites and outdoor entertaining area, double garage. So when you come to sell this property at retirement, or when you downsize your portfolio, imagine that you've suddenly got a 3 or 4-bedroom home with extra bathrooms. So the resale value will be higher, and you will achieve, you know, a lot better value. So imagine if you're selling this home to a home buyer that's got teenage children, each having their own bathrooms. Fantastic. I had teenage daughters living with me, obviously at one stage. Having their own bathrooms would have been a godsend. So, or if you've got an elderly parent that lives with you, these are perfect, got their own privacy. So, or you might sell it to an investor that's, you know, why buy the home down the road that's achieving, you know, $650 a week when this property will achieve $900 a week. So the end selling point of these co-living homes is much stronger, and compared to these other type of high co-living, high income properties, again, are a little bit limited in terms of end value. This co-living concept has the benefit of higher cash flow while you own it, but also you've got 2 exit strategies when you come to sell it down. See some lots of questions coming in, so keep rolling those through. I know I do new construction for clients. I've built new myself to live in and for investment many times over the years. So I understand the current concerns if you're new to construction and you've heard those, you know, those horror stories. The reality is, yes, the building industry was under a lot of pressure. You know, last year, again, we're building in Southeast Queensland. It was not a normal market, huge demand. Everyone was buying property. everyone was building home builder grants from the Queensland government, first home buyers, which was great. They were getting into the property market, but that really put a pressure on the building trade. But I had two clients homeowners going through construction that we handed over at Christmas, and they were actually ahead of the build contract. So don't tarnish, every property manager, every agent, every builder, every painter with the same brush. The majority of builders were still completing. So unfortunately, some of those builders, some builders didn't make it. But what we're seeing now is the market starting to get back to a normal market. We can buy materials, prices aren't increasing like they were. It's a much more stable construction market. So, but it is important if you're considering going through construction that you have a good quality builder and that you have someone managing that builder, and you make sure that that builder's got the resources to be able to complete your property and not have issues. So we've all heard the horror stories, which is very unfortunate, but again, dealing with a good company, you won't have those problems. So Gallery Homes is one of the builders that I've worked with for many, many years, and they've really listened to the market, those concerns about build and rental incomes, and they've come up with a guarantee that is better than anything I've seen in the property market. The benefit with Gallery Homes is they're a good sized builder. They own their own land developments, so they've got control of the land. So anyone that's gone through construction understands that developers, when they release the blocks, sometimes the titles, the dates can push out and it can delay construction. So the good thing about Gallery Homes is they actually own the land, so they're in control. They also have their own trades, so they're not relying so much on sub-trades to complete the builds. So they actually come up with a build guarantee that it's pretty fantastic. So they're guaranteeing in their own estates that they'll be on site within 4 weeks, which is faster than much faster than standard, much faster than other builders in the industry. Guarantee number 2, they're guaranteeing that they'll build your home within 18 weeks to practical completion stage. Again, and they've backed that up, so they haven't just, it's not just a verbal thing. They've actually put that in the build contract, and they've actually put a penalty clause in there. So that means if it goes over that time frame, they will pay you as the owner late damages payment of $120 a day for every day that goes over that build period. So that's a lot of confidence. And again, it's a sign of a company that's got their act together and really going through construction and have confidence in their materials and their prices. So for anyone that's concerned about construction, yes, you need to do your checks, you need to have all those things in place, and you need to really deal with a quality company. They also offer a rental guarantee as well there. So again, just confidence that the rental market is very strong. So they're guaranteeing that if your co-living property is not fully tenanted within 6 weeks, they'll pay you that difference in the rent per week until it's fully tenanted. So again, just confidence in the market and their process and their working environment. So where can we build these co-living? So again, as I mentioned at the start of the presentation, we do really need to build them in areas where there's demand, close to infrastructure, transport, employment. All that is very, very important. So they've got about 3 estates around the southeast Queensland corridor. So they've got one estate in Logan, near the Logan Hospital. They've got an estate coming up on the Gold Coast. So for anyone looking to invest in the Gold Coast, which is probably one of the hottest property markets in Australia right now, they do have some land there, a very small parcel, and they're offering some co-living options there. The property that you saw on screen around the figures, this was in a suburb known as Deception Bay, which is on Brisbane north side. So it's a great location. You can see it's close to the water. That's Moreton Bay. Beautiful area, lots of infrastructure. It's a very small infill development. That is great for capital growth because it means they can't simply release another stage of land. As you can see there, it's really landlocked. It's all developed. Existing homes, there's lots of commercial retail around that north side. Got access to the Brisbane airport, so it's a really good location. Vacancy rates in Deception Bay are exceptionally low. Train service up there, bus near the main highway going up between Brisbane and the Sunshine Coast. You've got North Lakes not too far away, which is a huge Westfield development. Costco, ALD again. So these are large companies, and they don't invest in areas unless they're confident of the longevity of that market and a growing population. So the next question is cash flow. As I mentioned at the start of the presentation, when you're buying an investment property and you're going to put tenants in place, it's really important to understand the cash flow, especially if you're new to property investment. Getting the numbers right and understanding how much that property is going to pay us or cost us per week is really, really critical. So I've done a cash flow forecast based on that particular property using some generic numbers there. So purchase price, 769,000. Used a deposit, 130,000. So that's about 10% plus purchase costs. Now this would be tailored to your specific situation, but again, it's just using some, excuse me, generic numbers. And a single person buying this investment property on a taxable income of about 80,000. So this is a property investment analysis. This is the cover page which shows the detail. So it sees the purchase price. It shows we've factored in inflation there. We've factored in the gross rent. So quickly to describe this, gross rent at $900 per week. It's about 46,000 per year. Interest mortgage payments about 34,000. Rental expenses, so rental expenses are rates, insurance, property management, bit of maintenance, pest control, etc. About 10,800. Depreciation very strong on a new property, which really helps the cash flow in the first few years. So cash flow on an investment property is generally the toughest when you first buy the property. The first 2 or 3 years, I think, is the toughest, learning from experience, because that's where you're really struggling to, with the rental income covering the mortgage and expenses. But over time, what will happen is that mortgage will be fairly stable, but the rents will increase over time. So what's something that might have been negatively geared today is going to be positively geared in the next 5 to 10 years. So we're basing the numbers with a 10-year projection, in this case, just to show you the type of net result. It's taxable income, so very good tax deductions on a property of this type. So after the income, less the mortgage and all the deductions, including the tax savings, this property is about $177 per week positively geared, which is far outweighing what a standard home would be. So I'm sure you'll have some questions around that. We would like to explain that in detail on one-on-one calls. So yeah, that just gives you the numbers over the first year. So 177 based on that numbers. Year 2, 200. So averaging over $200 a week after all expenses is a very strong cash flow property. Of course, that's interest only, because the reason for that is, for anyone new to property investment, generally the interest is a tax deduction, the principal isn't. So the general rule of thumb is if you've got debt on your own home, you're better off to have interest only on the investment property and pay the extra cash into your own home loan, which is a non-taxable debt. Whereas the investment property, as long as it's financed correctly, it should be a taxable debt on the interest only. So for those new to property investment, just a couple of tips there. So I am a licensed property buyer's agent, so I'm just explaining the buyer's agent role, how we operate, and the benefits, what we do. So if you're, don't understand the looking to invest, and that's your budget in that price point, and you've decided, Southeast Queensland is the market to invest in, you need to know all that information that I previously explained. So what we're finding now is a lot of people don't have the time. They don't have the knowledge, and they don't have the expertise to find the properties, to do the inspections, do the negotiating, etc. So that's really the role, of a buyer's agent. Just like when you sell your property, a sales agent will get you generally way above what the normal market would expect. A good sales agent, you employ them and you pay them to get you the maximum price. With a buyer's agent, you employ the buyer's agent to get you the best option and numbers. So if you're looking at engaging a buyer's agent, some key questions you should be asking them. How long have they been in the industry? Are they a property investor themselves? How many, are they helping clients? Can they show you some evidence of that? They need to have a high level of industry and market knowledge. So it's very important. So personally, what I do for my own clients is I'm driving around the areas looking at what's going ahead in terms of the infrastructure, the builds under construction, giving the clients feedback, confidence. If you're an interstate buyer, you really need to be, someone that's in your corner, keeping you on top of that, negotiating on properties, looking for the best angle. A lot of these properties are sold off market, so you can't find them in traditional portals. So you need to understand that if you're going through looking at a co-living, again, that you've buying in a good location, you've got a builder that can build it. There is some compliance with co-living. They have different doors, door stops, hinges, things like that, locks. There's smoke alarms. There's some differences there in the construction. So a standard builder that doesn't understand co-living or is not building them, I would be very wary of going down that path. Buyer's agent role is to find properties matching your criteria, so your budget, your goal of, is it higher cash flow, is it a combination of cash flow and capital growth. Engaging a buyer's agent gives you a better chance of securing a property. I know home buyers that have spent a long time looking at properties and missing out in a competitive property market. These types of good properties and good areas go very, very quickly. So having someone be able to get onto the property when it's listed or secured very quickly, and understanding how to negotiate to secure that property is very important in a competitive market. Another benefit of having a experienced buyer's agent is they'll have a lot of relationships with in terms of new land developers, builders. If I'm sourcing existing properties, I've got a list of agents, and if there's something matching my client strategy, they'll give me a call and say, hey Geoff, I've got something coming up. I've been sourcing some development sites, so larger land parcels with a land component for clients. So quite often we'll get notified of those properties before they hit the market. And it makes sense for the selling agent, because they know if we're a buyer's agent's approach them about a property, they've already got a client, probably financed, ready to go, and ready to make a decision, not going to waste their time. So it works well for, really both parties. But as you, as the buyer, it gives you the confidence that you're not going to overpay for the property, and you're going to get all the data reports, the CoreLogic reports, vacancy rates on the property. If it's an investment property, you really need to be understanding the cash flow. So again, a good buyer's agent will be able to do that for you. As a property investor myself, I understand all those fundamentals that we talked about are, really, really important. And of course, the time saving. So saving that time, I know everyone's busy. If you're running a family or working, crazy hours, you can really miss out on the best opportunities. So my contact details are on the screen there. Hope this answered all the questions, and everyone's seen the benefit of this high cash flow property. I hope everyone's seen what's happening in the Australian market, that turning in the confidence. And for those that are getting into the investment property market, very strong indicators for that long-term, growth. If you're looking for other types of property investment, co-living is not your thing, and you're looking in the Southeast Queensland property market, yes, welcome to have a conversation. I source standard homes, built properties, development sites, dual occupancies, duplex pairs, etc., as well as a standard home. So this is, I believe, really a concept that's really going to take off, and really gives the investor the best of both worlds in terms of cash flow and capital growth. Okay, thank you everyone for attending tonight. I'm going to wrap up the webinar. Welcome to reach out. Have a great evening. Hope you've gained some information about the content that we've featured tonight. Okay, thank you everyone, and have a great evening, and good luck with your property investing journey.